What's going on, everybody? I hope you had a great weekend. This is Michael Smith here with the Bluefield Group, coming at you with another Market Update Monday. And I want you to bear with me on this one because I'm going to get a little in the weeds with some numbers, but some really interesting stuff we're going to go over. So let's go ahead and dive in. So what we're looking at right here is some numbers that were released from the Bureau of Economic Analysis. We're looking at annualized growth or decline in gross domestic product for the U.S. GDP. So in the fourth quarter of 2018, we saw a 2.6% increase in GDP here in the US. And that actually beat the projections a little bit. The estimate was that we were going to be somewhere around 2.2. We ended up at 2.6, which is good. As you can see, we've had a pretty consistent stretch of GDP growth here in the US. And we're actually coming up on the longest running expansion of the US economy. So if we continue this trend for 2 more quarters and we make it all the way to July without a decline in GDP, we will officially be in the longest running stretch of economic growth our country has ever seen, which means we're overdue for a recession, okay? So on average, historically, recessions have occurred in our country about every 7 years. Sometimes there's less of a time in between, sometimes it takes a little bit longer, but the average is about 7 years, and we've been going pretty strong for quite a while. What I want to look at here next is the yield curve, and that is one of the best indicators to project whether or not we might be about to enter into a recession. So the red line here is the yield curve from 10 years ago, end of February 2009. The blue line was actually from yesterday. I just pulled this data. So the yield curve, for those of you who don't know, the U.S. Treasury issues bonds to raise money to finance the deficit. And they sell the bonds in different increments, different maturities. So you can buy a 1-month bond, 2-month bond, a 6-month, 1 year, 2 year, 5 years, 10 years, 15, so on and so forth, okay? And what we see is typically the longer the duration, the higher the interest rate, which is pretty typical. If your money is going to be tied up for a longer period of time, you would expect investors to demand a higher rate of return on their money. And a yield curve that goes up is pretty common, okay? Now, interestingly enough, when people get uncertain about the future, they start to divert money away from the shorter term bonds and dump that money into longer term bonds, because if you buy a 2-month treasury note, in 2 months you're gonna get your money back and you have to reinvest it. And so when there's uncertainty about what's gonna happen in the economy in the short term, people don't want to have to continue to get their money back and reinvest it because the thought is they're not going to be able to get as good a rate of return. So they're going to dump their money into longer term stuff because at least they know their money is going to be making that for that longer period of time. There's less risk. So as that starts to happen and people pull money out of the shorter term stuff and put it into the longer term stuff, we see this unique phenomenon called the flattening and eventually the inversion of the yield curve. So we're going to see, as you can tell, the curve right now is almost flat, which means that the rate of return on a very, very short-term bond is almost the same as the rate of return you'll get on a much longer-term bond. And interestingly enough, if we get to the point where the curve actually inverts and you get a higher rate on short-term bonds compared to longer-term bonds, that is actually the best predictor historically that we're about to enter into a recession. So the next slide, we're going to take a look at historically how an inverted yield curve has impacted the economy. So going all the way back to 1977, what we're looking at here in this graph is the spread between a 2-year and a 10-year US Treasury note, okay? So if it's at 0, that means there's no difference in the rate. You're getting the exact same return on your money in a 10-year compared to a 2-year. Normal circumstances would have us above 0 because you would expect there to be a positive spread between the 2 and the 10-year bond. Every once in a while, this weird thing happens where the yield curve inverts because people are shifting money from short-term to long-term notes, and we get below 0, which means the curve actually goes down. It's called an inverted yield curve. And historically, whenever that has happened, we've entered into a recession. These gray bars here indicate when our economy has gone into a recession. And a recession technically means 2 consecutive quarters of decline in GDP, gross domestic product. So as you can see, here we are, January 2019, the spread between the 2 and the 10-year treasury notes has been slowly shrinking, and we're almost at 0. And when we looked at previously, you could see the curve was almost flat. So this is something we definitely want to keep an eye on, because if the yield curve starts to invert, historically that means we're probably going to enter into a recession. So again, if we make it all the way to July of this year without that happening, we will officially be in the longest stretch that our country has ever seen of economic expansion. So I don't want to scare anybody to say that the sky is going to fall and the whole economy is going to collapse tomorrow, but it's just something that we need to keep an eye on, because the overall economy definitely has an impact on the housing market. So I hope that you stayed with me through this whole video. I know it's a lot of numbers. I enjoy this type of stuff. I know not everybody does, but I try to do this research so that you don't have to. So I hope this was valuable for you. If you have any questions, please call or email us. We'd love to touch base with you and put together a plan to help you make an informed decision going forward for this year. Thanks so much.